Welcome back. So we're looking at the economic landscape for early 2026, and I have to be honest with you, I am getting serious whiplash.
It's a confusing time, no doubt about it.
I mean, I look at my investment app, and the S&P 500 just hit 7,000, an all-time high. Everyone on Wall Street is popping champagne.
It's a very sunny picture if you strictly look at the index funds, sure.
Right. But then I close the app, I walk into the grocery store to grab a bag of Doritos, and I feel like I need a credit check just for snacks.
Mm-hmm.
And if I think about booking a trip to Europe, the dollar buys me way less pasta than it did a year ago. It feels like the economy has a split personality.
That's the perfect way to describe it.
Yeah.
It's a classic disconnect.
Yeah.
We have record-breaking stock performance happening at the exact same time as, well, a legitimate cost of living crisis and, frankly, some very dark storm clouds gathering.
So that's what we need to unpack today. This market update for the first quarter of 2026, we've got to look past the shiny stock prices and get into the actual machinery of the economy.
The shrinking workforce, the massive government debt.
And why international markets are suddenly leaving the U.S. in the dust.
And we absolutely have to talk about the Greenland Incident.
Oh, we are definitely getting to Greenland. That story is just wild. But let's start with the pain point everyone feels. Inflation. The headline number is 2.7%.
Right.
Now, compared to the crisis peaks, that sounds okay. It's not 9%, but it's still above the central bank's target. My question is, if inflation is down, why isn't my grocery bill dropping?
This is probably the single most frustrating thing for people to wrap their heads around, and economists do a terrible job of explaining it.
Okay.
What we're experiencing is disinflation, not deflation.
Okay, let's break that down, because they sound like the same thing, but they definitely don't feel the same.
Think of it like a car. In 2022, prices were speeding up going 100 miles an hour. That's high inflation.
Right.
Disinflation means we took our foot off the gas. So now prices are only moving at, say, 30 miles an hour. But, and this is the key, the car is still moving forward.
Prices are still going up, just slower.
Exactly. Deflation would mean putting the car in reverse and going back to where we started.
And we are not in reverse.
We are definitely not. That bag of Doritos you mentioned, its price tag jumps significantly. Even if it stops jumping so fast, that higher price is the new baseline. It's baked in.
So unless there's a huge depression, we're not going back to 2019 prices.
Not a chance.
Right.
So when you hear the news celebrate beating inflation, they really just mean we're getting poorer at a slightly slower rate.
That is a cynical way to put it.
But it's mathematically true. The rate of pain has decreased, but the accumulated pain is still there, and this ties directly into interest rates.
Right. We've seen rates come down a bit from their peak, but they seem to have hit a plateau. They're stuck.
They have. The central bank isn't expected to make any more drastic cuts right now. So, mortgage rates are sitting roughly between 6 and 6.25%.
Which is a shock to the system for anyone who bought a house 5 years ago.
I mean, the days of the 2.5% mortgage are likely gone forever. That was a historical anomaly.
So this is the new normal.
This is the new normal cost of money. And while unemployment has ticked up a bit, the economy is still technically growing. But that growth number is where things get really murky.
This is where I got stuck. Official government data says U.S. GDP is growing at a massive 4.3% annualized rate. That's a boom.
It is.
But then I see private economists whispering that the real number is actually less than half that, maybe 1.9 or 2%. How is that possible?
It's less about anyone lying and more about messiness. Remember, we had that government shutdown back in October 2025.
Oh, right.
That created huge gaps in data reporting. On top of that, there's been a complete overhaul of global trade policy, which makes tracking imports and exports a nightmare. So yeah, the official print says 4.3%, but most pros are forecasting something closer to 2% growth through 2028.
Okay, so let's assume 2% is the reality. How do we even fix that? What's the formula for making an economy grow?
It's surprisingly simple. It really comes from just two buckets. Bucket one is labor. Do you have more people working?
More hands on deck.
And bucket two is productivity. Can those people produce more stuff per hour?
So better tools for the hands we have.
That's it. And right now, the U.S. is facing a mathematical crisis in bucket one. We are staring at an immigration cliff.
I know this is a hot button issue, but just looking at the numbers, what is happening to our workforce?
The Census Bureau data is stark. Net immigration has dropped by roughly 75%.
Wow, 75%.
And just to be clear, this isn't only about illegal immigration. The screws have been tightened on legal immigration, too. It's just much harder to move to the U.S. to work.
So putting politics aside, if you just look at the economic engine, we have fewer fuel injectors.
Precisely. If you have fewer workers entering the system, it is mathematically harder to grow the GDP. It's harder to find people to frame houses, which keeps housing costs high. It's harder to fund Social Security and Medicare.
Because they rely on a growing base of young workers.
Exactly. If you take away 75% of the new entrants, the math starts to break.
Which puts a tremendous amount of pressure on bucket 2, productivity.
It's the only option left. That's the bet the U.S. economy is forced to make. If the blue bar of labor is shrinking, we have to rely entirely on the gray bar of technology and AI.
So companies are pouring money into AI not just because it's trendy?
But because they have to. It's a survival strategy. They need to squeeze more output from the same number of people because the cavalry isn't coming.
But even if robots save us on productivity, we still have to pay for the past. And this brings us to the part that honestly terrified me. The debt.
The debt behemoth.
The numbers are just abstract.
Yeah.
$37 trillion, $38 trillion. It loses all meaning.
Let's make it concrete. We're putting about $1.7 to $1.8 trillion on the national credit card every single year.
Every year.
But the stat that keeps me up at night is the interest bill. The U.S. government is now paying about $1 trillion a year just in interest.
That is insane. That's not paying down the loan. That's just the minimum payment.
Exactly. And it limits everything else the government can do. But the immediate danger is something called the refinancing cliff.
I saw this term. It sounds awful. What is it?
It's a timing problem. A huge chunk of U.S. debt, about $10 trillion, matures in the next 24 to 48 months, starting right now. The loans are due.
And I'm guessing the government doesn't have $10 trillion in cash to pay it back?
Not even close. So they have to refinance. They have to issue $10 trillion in new bonds to pay off the old ones.
Wait, isn't that basically a Ponzi scheme, paying old investors with money from new investors?
In government finance, it's called rolling over the debt. But here's the danger. We're rolling over debt that we took out when interest rates were near zero.
And now we have to refinance at 4% or 5%.
Which means the interest payments on that chunk of debt are going to double or triple overnight.
And that's assuming people even want to buy the new debt.
That's the ultimate risk. You need lenders. You need other countries to show up to the auction and buy those bonds. If they don't, interest rates could spike.
And this is where it gets weird, because you don't want to insult your banker when you're asking for a loan, but that's what happened with the Greenland Incident.
A perfect example of how political rhetoric has real-world financial consequences.
For anyone who missed this because it sounded like a joke, what actually happened?
Well, U.S. leadership made some very aggressive comments suggesting that, given the debt, the U.S. should look at acquiring strategic assets like Greenland.
Not partnering, but acquiring.
Exactly. It was framed almost like a seizure, and it did not go over well in Denmark.
I can imagine.
It was a diplomatic disaster. But more importantly, the financial markets reacted. A major Danish pension fund sold off $100 million in U.S. Treasury bonds in response.
Okay, devil's advocate here. In a market of $38 trillion, isn't $100 million just pocket change?
The amount doesn't matter. The signal matters. It was a buyer strike. It showed that political instability can cause lenders to walk away.
It's a warning shot.
A huge warning shot. And it wasn't just Denmark. We saw a bond auction in Japan recently, a $280 million auction that, relatively speaking, failed.
Failed, as in nobody wanted to buy them.
It means there wasn't enough demand at the offering price. The interest rate had to spike by 1/4 of a point just to get the deal done. And if that can happen in the massive Japanese market, it proves liquidity can dry up fast.
So if lenders get nervous or annoyed, our interest rates could just spike uncontrollably.
And that $1 trillion interest bill we talked about gets even bigger. It's a very dangerous feedback loop. And frankly, the market is already sniffing this out in the currency.
Which explains my expensive vacation planning. The dollar.
Yeah, the shift has been dramatic. The U.S. dollar declined about 10% in 2025, and it's down another 2% just in January.
And that's all from this combination of debt fears and geopolitical tension.
Exactly. Plus, changes in global trade policy. The result is that imports, travel, everything is more expensive for Americans.
But there is a flip side here, right? Because while the dollar is dropping, international stocks are absolutely crushing it.
This is the surprise of the year. Last year, in 2025, U.S. stocks were up about 17%. A great year.
Fantastic year.
But emerging market stocks did more than twice that.
Twice.
Brazil was up over 50%. China was up 31%. Almost every major country outperformed the U.S., except for India. And that trend is continuing right now.
Okay, explain the mechanics of that. How does a weak dollar help my stocks in Brazil?
So imagine you own a share of a Brazilian company priced in Brazilian reals. Let's say the stock price itself stays flat. But during that time, the US dollar gets weaker.
Okay.
When you translate the value of that Brazilian share back into dollars for your portfolio statement, it just looks like it's worth more. You're winning on the currency conversion alone.
It's like a tailwind. You get the stock growth, if there is any, plus the currency bonus.
Exactly. And after a decade where the US dollar was king, the wind has finally shifted.
So investors are realizing, hey, maybe I shouldn't have 100% of my money in U.S. tech.
That rotation is happening in a big way.
Which leads to the big question. We have the S&P at 7,000. We have international markets booming. Is the U.S. market a bubble?
It's the $7,000 question, isn't it?
Yeah.
The S&P is trading at about 22 times forward earnings.
And for context, is that high?
It is very high. The last time we saw valuations this stretched was the dot-com bubble.
Oof, that is not a comforting comparison.
No, it's not. However, and this is the big however, there's a massive difference. In the dot-com era, you had companies with no revenue. Today, these are cash machines. Earnings grew 11% last year,
Right.
and they're projected to grow 15% over the next 2 years.
So the price tag is high, but these companies are actually earning enough cash to maybe justify it.
That's the hope. That's the bull case.
Oh.
You want valuations to come down, not because prices crash, but because earnings go up so fast they catch up to the price.
Okay, so what's the play here? A pricey U.S. market, a booming international market, and this scary debt situation. What do you do?
You don't panic. Please do not sell everything and move to Brazil.
Okay, so no panic.
The verdict is everything in moderation. I see people asking if they should put 50% of their portfolio into international stocks because they have FOMO from the last 6 months. The answer is calm down.
Don't chase the hot thing just because it's hot.
Exactly. Diversification is key. You want some exposure to that international growth, absolutely. But you don't abandon the U.S. market. It's still the deepest, most liquid market in the world.
And what about bonds? With all the election year noise, should people just flee to safety?
Well, bonds did well last year, but going all in on safety introduces a new risk.
Which is?
The risk that your portfolio won't grow fast enough to actually fund your life. It's the risk of running out of money versus the risk of losing money temporarily.
That's a great way to think about it.
And speaking of the election, the best advice for 2026 is to separate your politics from your investing.
That is so hard to do.
It is incredibly hard. You might hate one policy or be terrified of the opposition, but if you let that drive your portfolio decisions, if you sell because you think the country's going off a cliff politically, you will almost certainly lose money.
Stick to the long-term plan.
Markets are cold-hearted. They march to the beat of earnings and interest rates.
So tune out the noise, look at the earnings, and maybe diversify a little more globally.
That's the prescription.
Before we wrap up, I want to leave our listeners with one final thought. We've talked about numbers and deficits, but listening to you explain the debt auctions and the Greenland story, it feels like underneath all of this is something more fragile.
It's trust. The entire global financial system, the reason the U.S. can borrow $38 trillion, is based on the assumption that the U.S. is the safest place in the world to put money.
And for the first time in decades, that assumption is being stress tested.
We are entering a period where the risk premium on U.S. debt is being questioned. The economy is growing, yes, but the safety net, the trust that lenders have in us, is fraying at the edges.
Those failed bond auctions and buyer strikes.
Those are cracks in the foundation. We can fix them, but we cannot ignore them.
A sobering but necessary perspective. We will be watching those bond auctions closely. Thank you for listening and continue to follow for next release.